Welcome to Balkrishna Industries Q3FY22 Earnings Conference Call hosted by DAM Capital Advisors Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from DAM Capital Advisors. Thank you, and over to you, Mr. Jain.
Thank you, Nirav. Good morning, everyone. On behalf of DAM Capital Advisors, we would like to welcome you all to the 3Q FY22 earnings conference call of Balkrishna Industries. To represent the management, we have with us Mr. Rajiv Poddar, Joint Managing Director, Mr. MS Bajaj, President Commercial and Chief Financial Officer, and Shogun from SGA, Investor Relation Advisor to the company. I will now hand over the call to the management for brief opening comments. Post that, we will begin with the Q&A session. Over to you, Mr. Rajiv.
Hi, thank you. Good morning, everyone, and thank you for joining us today. Hope all of you, along with your near and dear ones, are safe and healthy. Along with me, I have Mr. Bajaj, President Commercial and CFO, and also SGA, our Investor Relations Advisors. Let me begin with performance updates. Across geographies, we continue to see robust demand for our products. The macro challenges continue to be in terms of raw material costs and logistics. Specific to the quarter 3, higher power and fuel costs and increased marketing spends besides raw material cost pressures have impacted EBITDA. Having said that, we continue to maintain 28 to 30% EBITDA margin on a long-term sustainable basis. All our capex plans are on track, and we expect to take benefit of the strong demand via the capacity additions at Waluj and Bhuj plants. Let me recap the capacity profile. The current achievable capacity is 285,000 metric tons per annum, including the new Waluj plant that commenced operations in September 21. The brownfield capex at Bhuj, announced in February 21, will add 50,000 metric tons per annum, while the old Waluj plant, which is being revamped, the capex for which was announced in November 21, will add 25,000 metric tons per annum. Accordingly, the entire capacity by the end of financial year 23 will be at 360,000 metric tons per annum of achievable capacity. At BKT, while we remain focused on growing our business, we continue to invest in sustainability, whether it is solar power investments, co-generation power plants, feed plantations, safety and hygiene protocols for workers at plants, green products, and training and education. We are now in the process of ESG review and will be publishing our first integrated annual report in the 60th year of our company, thereby giving you a more detailed view on our processes and practices for sustainability. The Board of Directors have declared a third interim dividend of Rs 4 per equity share in addition to the Rs 8 per equity share that has been paid for the first half of this financial year. Additionally, the Board of Directors has declared a special dividend of 12 rupees per share to mark the Diamond Jubilee year, that is 60 years of our company. With this, I now move on to the operational highlights. Our sales volume for the quarter was 70,320 metric tons, a growth of 18% year-on-year. For 9 months of the financial year, sales volume stood at 211,676 metric tons, registering a growth of 33% year-on-year. Our standalone revenue for the quarter stood at 2,079 crores, which is which includes realized gain on foreign exchange pertaining to sale of rupees 49 crore. For 9 months of the financial year 22, revenue stood at 5,987 crore, which includes realized gain on foreign exchange pertaining to sales of rupees 94 crore. For the 9 months of this financial year, 54% of the sales came from Europe, 18% from India, 17% from Americas, and the balance from rest of the world. In terms of channel distribution and channel contribution, 70% was contributed from replacement segment, while OEM contributed to 27%, with the balance coming from offtake. In terms of category, agriculture segment contributed 66% in the 9 months of this financial year, while OTR, industrial, and construction contributed 31%, and the balance came from other segments. The standalone EBITDA for the quarter was at rupees 507 crore with a margin of 24.4%. The EBITDA for the quarter has been impacted by higher RM cost to the tune of 190 basis points. This is on Q-on-Q basis, along with higher expenses primarily on the power and fuel and marketing expenses. For 9 months, the EBITDA stood at 1,606 crore with a margin of 26.8%. Other income for the quarter stood at 31 crore, while unrealized gain stood at 17 crore. For 9 months of the financial year 22, other income stood at 133 crore, while unrealized gain stood at rupees 60 crore. Coming to the net forex items, for the quarter, we incurred a net forex gain of 80 crore, which includes realized gain of 64 crore and unrealized gain of roughly 17 crore. For 9 months 22 of financial year 22, we incurred a net forex gain of 190 crore, which includes realized gain of 130 crore and unrealized gain of 60 crore. Profit after tax for the quarter was recorded at 329 crore with a margin of 15.8%. For 9 months of the financial year, profit after tax stood at 1,037 crores with a margin of 17.3%. The 9 months for the financial year 22, profit after tax was impacted by crystallization of contingent liability to the tune of 65.4 crores post completion of certain tax assessments which was charged in Q1 and Q2 of this financial year. Our gross debt stood at 1,881 crore at the end of 31st December 21. Our cash and cash equivalents were at rupees 1,927 crores, implying a net cash position. For 9 months 22 of the financial year 22, we incurred a total capex of 912 crore. Of this, approximately 852 crore has been spent on the new capex program of 2,250 crore, which was announced earlier. For the quarter 3 of financial year 22, the euro hedge rate was 87.3%, was rupees 87.3. Forward hedge rate for currently stands at around 89.60. With this, I conclude my opening remarks and leave the floor open to question and answer.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Sir, how much price increase you have taken from January?
So we have not taken anything in the Q3 or in the last quarter year. In this current quarter, we have not taken any price increase. In the quarter 3, we have taken roughly 2 to 3% of price increase.
When it was basically which month we have taken?
In the beginning of quarter 3, we've taken a 2 to 3% price increase.
Okay, so there is no price increase post October, you mean to say. And how much RM cost increase we expect in this Q4 versus Q3?
2 to 3%.
So will there be further margin pressure going ahead, like because there is no price increase we have taken so far?
No, we expect it to be similar to current levels.
Okay. And lastly, what is it? Obviously, because the increased ocean freight costs, we are basically passing that to the customers. So in our pricing today, whatever relation we had for the quarter down 296 rupees, what would be freight cost component in that?
We don't have the current breakup with us. We can get back to you.
Sure. Okay. Thank you. Again,
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal. Please go ahead.
Hi, sir. I have one question. With respect to our current run rate of production, we are already at about 70,000 plus. So, do we expect any further improvement in this production level till the time new capacity comes, or we should be in that 70 to 75,000 quarterly run rate of volumes for next 3 quarters?
Yes, this should be the run rate for the next 3 quarters. Same.
Okay. And with respect to the end markets growth, so are you seeing growth across segments, be it agri and OTR, or there is some, if we go by the indicators for agri side, there seem to be some softening in terms of agri indicators and even in the global market. India also has been weak, but global also.
So it is across all the segments of products. We are seeing a good demand.
Okay, so no softening yet in any of the categories. Okay, great. So thanks. I'll fall back in queue.
Thank you. The next question is from the line of Vimal Gohil from Union Asset Management. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, firstly, I would like to know, in conjunction with the global OHT market, what would be our market share currently? And then I have a couple of data point questions.
So basically, it would be roughly about 5%.
This is your total market share, including agri and aftermarket.
Yeah, no, globally, so global market share across all off-highway segments, we are roughly market share is about just about around 5% approximately.
Okay. And how much would the market growth, sir, at this point in time?
Market growth is roughly about 3 to 4% year on year.
Okay. So I was just looking at some data, and the market share, the overall market has not grown for the past few years, whereas PKT has indicating market share gains. So just wanted to get a sense that are we, in terms of the industry, are we at the bottom end of the cycle, and probably the industry could probably, show some market growth driven by mining and infrastructure in the US, etc. So do you have any views on the market growth, overall market growth going forward?
So I think if you see an average over the period of 5 years, the average growth would continue to remain between 3 to 4%. You could have some sprouts here and there, some sprouts of growth here or there, but averagely it would be between 3 to 4%.
Right. So our inherent assumption is that our market share will continue to grow. Because obviously our volume growth is going to be higher.
Yes.
Okay. And sir, just 2 things. OPEX growth in this particular quarter of 50% YOY. Could you just highlight the reason, what has contributed to that? And secondly, on India volumes. So they have been sort of soft for a couple of quarters now. How should we sort of read them going forward? Should we expect an improvement, or what is the reason for that particular soft? Yeah.
So basically, on the OPEX impact has mainly come on 2 main accounts. I mean, apart from raw material, it has been on 2 main accounts. It has been on power and logistic cost.
Okay. And sir, India volumes, how should we? What has led to this sharp decline in the last couple of quarters, and how should we see it going ahead?
So I mean, the decline is in percentage terms, but if you see the numbers per se, they are not declining. It is because the export has been, the way the growth has come and export has got a higher share of those products. It has been for that. It is not that there has been a reduction in absolute numbers of tonnage being sent to India. It is a percentile, so when last year was at about, say, 220,000 metric ton, we were at 22% of that. Now this year, our target guidance is about 285. Out of that, we will be roughly 20% by the year end. So if you see the actual numbers, there's a growth. The growth percentile was smaller. Absolute number, there's a growth. But if you see the percentile, you'll see some difference in there.
Okay. Anyway, I'll take this offline then. Thank you. Thank you so much.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thank you, sir. Sir, how much increase in the ad and promotion expenses in 9 months FY22, and how would be the trend going forward?
So as we mentioned that, we spend in aggregate to the tune of 120 to 130 crores. And, we see a huge benefit of these ads, advertisement and sponsorships that we have been doing. And this, helped us in our brand building activities and brand recall activities. And we expect this to continue. For the next few years to the same tune.
Okay, sir. And sir, despite the muted tractor volumes by OEMs, our sales mix has improved towards the OEMs, and and also margin is going down. So have you won new business from the OEM side in the last quarter?
There's a marginal increase on the OEM side, but that is just a part of our business cycle which is there. So it is not anything to do with lower prices or anything. It's just a business cycle. It's a marginal gain.
Is it also impacting the margin?
No. That's why I said it's a marginal gain, not to impact our EBITDA margin or anything. EBITDA margins have been impacted mainly on 3 accounts. Your power, fuel, logistics, raw material, and some part of it has been also marketing expenses which have got bundled up together in Q3.
Okay. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Nikshita Mehta from Credent Asset Management. Please go ahead.
Good morning, sir. So I had questions on again the freight situation and the cost situation. Basically, how long still do you think this will persist? Can you just give us an overview of the industry?
So on the freight cost, we are also. It's a challenging situation for everybody. It's unprecedented times. One is there are 2 aspects to that. One is availability of containers, to dispatch the material, and second is the cost. So we are also waiting and watching and reviewing it on a daily basis. It's very difficult to make any sort of comments on that at this stage. But we are waiting and watching and reviewing it closely. That's all what we can say at this stage.
Okay. And will then our order book or our sales volume be affected because of this? I mean, how much do you think it will be impacted?
So I think our team has been able to do a good job to make sure that sales is not affected due to availability. We have managed to keep that in check, and we are quite hopeful to continue to be able to manage the situation from an availability point of view. Cost is something which is a second aspect at this stage, and we are reviewing that closely, and we'll take a call as and when we get more clarity on that.
Right. And just another question that your existing capacity is, I think, 285,000 metric tons, right?
Yes.
Yeah. And you've given a guidance of volumes also about 285,000,
yes.
Right?
Yes.
So I can assume 100% capacity utilization and sales.
Yes. Almost.
All right. Thank you so much, sir.
Thank you.
And good luck.
Thank you.
Thank you. The next question is from the line of Pramod Amte from InCred Capital. Please go ahead.
Yeah, hi, sir. How has been in the international markets your competitor pricing action in the recent months?
So it is broadly in line with what we are doing. and it's in the similar lines.
So for them also the last price hike was 5 months back, or do they take usually a Jan-Feb hike and you haven't taken?
I mean, there's nothing announced so far in this year, but we are reviewing and watching them closely, and then we will take a call from there.
Sure. And second one is considering that many of your competitors might be producing within Europe and supplying there. How is the power scenario for your OTR tires? What's the power cost for you versus how they compare? And does that pressure which is seen in Europe, should that give you a tailwind or a headroom to raise as the competition raises for you also to raise, but your cost may not be going up?
So power cost is something which will be generically going up for everybody, because internationally coal has gone up internationally, not just for India or Asia. So the power impact should be similar for everybody across the world. But as you said, for Europeans manufacturing there, the shipping cost would be a little bit of an advantage to them. Also, if you see, Europe is using mainly gas, so the prices of that has also gone through the roof. So, that impact would be there for them as well.
But as a percentage of sales, what might be the competitors' power cost?
No, we don't have those details. But
you don't expect them to take a forceful pricing action because the power costs have spiked up for them?
I mean, they will have to decide for them what they want to do. And we are reviewing the situation. In case anybody does anything, we will also react.
And so going forward, how do you plan to increase your per kg realization till the new capacity comes on board? Because you are running full on the capacity. And if I have to build further on the momentum on top line, it has to come either by the price hike or your own actions on product mix. Anything on product mix improvement to be seen in next 2-3 quarters?
No, we don't look at product mix from a perspective of short term. It is more about servicing the end user and giving him the entire basket of products that we have. So we don't see any product mix change coming up. On a price increase or price hike, that's something we are watching closely. What the market is doing, how they're doing, how market is accepting, and then if also the cost, how they're increasing or are they sustaining, and then we will take a call. But at this stage, there is nothing.
Sure. Thanks and all the best.
Thank you. The next question is from Vasudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks, sir. Just to continue with the previously discussed point, just wanted to understand March quarter last year where your realization per kg was some 57 rupees, and now it is 290.
Sir, sorry to interrupt you, but you are not audible. Hello.
We can't hear you.
Vasudev, may I request you to speak louder, please, and through the handset.
Am I audible?
Yes, better.
I just wanted to understand, sir, your realization in March quarter last fiscal was some 257 rupees a kg, and now it is 296. So almost 40 rupees a kg increase. How much of that is price hike, how much is mix change, and how much is logistics inflation?
I mean, it's a combination. So I mean, largely it is. I mean, we don't have a breakup of what is contributing to raw material and what is contributing to logistics, but it is mainly on account of both of these, and it is a part of the entire cost that we are passing to them.
Okay, and just because this time the raw mat inflation has been so severe, so whenever in future you see some raw material reversal, do you see corresponding price benefit getting passed on in replacement in sync with peers, or you think that won't happen much?
Yeah, so normally that's what is the nature of business. It gets passed on. There may be some time lag which you are seeing in the current quarter, but by and large, that is what will happen.
In replacement also?
Yes.
Okay. Thanks.
Thank you. The next question is from Siddharth Bera from Nomura. Please go ahead.
Yeah, thanks for the opportunity. Sir, when we look at the commodity cost and when you have said that about 2 to 3% more increase you expect in quarter four, does that factor in the current crude prices of about $95-96, or you think based on these numbers there can be further inflation which can come subsequently in the next quarter?
So we are holding old stock also, and that is what we are taking that into account. And also current oil levels, also this we are factor that in as well. There is something drastically upward or downward that may have an impact, but with current levels it is factored in.
Oh, so current you would say crude levels are factored in, and on top of that it will depend on. And second question is, sir, again on the price hikes, when the demand is so strong and across geographies segments, so the pricing action is determined by competitors, or what is probably getting to this delay in raising the prices? When you say you have not, or probably in quarter four because of the commodity cost, don't you think you may need to take more price hikes?
So we are reviewing the situation. It is not just every quarter that you can pass on. We have taken hikes in Q3, as I said earlier. We are reviewing the situation in case the the costs and expenses don't subside. We will be forced to look at another price increase. We are working on that. We are reviewing the situation, and we will take a call at an appropriate time.
Okay. Got it, sir. Okay, I'll come back in that way.
Thank you. The next question is from Ronak Sarda from Systematics Group. Please go ahead.
Yeah, hi. Thanks for the opportunity. So firstly, few data points. What was the production in the quarter and 9 months?
Similar at roughly 70,300 tons.
Right. And for 9 months, it would be largely in line with what we have reported?
For 9 months, it would be roughly 213,000 tons.
Sure. Okay. Thanks. And what would be the RM cost in terms of natural rubber, synthetic rubber for the quarter, and how it has, for the quarter, if you can share the numbers?
So synthetic rubber cost is almost same this quarter and last quarter, but natural rubber cost has gone up. Last quarter it was 141 to 142 rupees, and currently around 160 rupees.
160. Right. I have a question on the commodity side. So we have seen natural rubber having pretty long cycle, and for the last decade it has been in a downward spiral. Do you think this is the beginning of an upcycle in commodity, especially natural rubber, or how do you see the outlook here over the medium term?
So we think that the prices have already shot up quite a bit. We think it will sustain it here, or maybe small increase may come on this, but we don't see. We don't hope for or we don't see a very big jump coming up from here.
Yeah, right. I mean, in its peak in the last decade, or maybe in early 2007, 2008, it was almost at 240, 250 rupees.
Yes.
So, do you think it can inch up to those levels? I mean, how is the demand-supply situation on ground?
So there is no shortage as such. The demand and supply is fairly even. So looking at that, we don't see it to jump up drastically, from here.
Okay. And finally, I missed the euro hedge rate which you mentioned in your opening remarks. So what was for the quarter and what is the forward hedge?
Euro hedge rate for the quarter is at 87.3, and for the year is 89.6.
So 89.6 for the forward quarter, you're saying, right? The forward 12 months.
Yes.
Okay, sure. Thank you.
Thank you. The next question is from the line of Mumkush from MK. Please go ahead.
Yes, thank you so much for the opportunity, sir. So OEM segment has grown strongly over the last few years. So what is the outlook in the OEM category for both agri and construction equipment segment for CY22, and what kind of outperformance we expect, sir?
So on the OE, we expect to sustain this levels that we've reached. And, with all the brand building activities we are doing, the brand recognition that is coming through, maybe a couple of percentile, it may go up.
Right, sir. And sir, on the what was a carbon black sales in Q3 and 9 months, sir?
So to the third party?
Yeah, to our revenue also and third party as well.
So third party was roughly about 17% of our capacity, and in terms of revenue, it is overall less than 3% of our overall sales revenue.
And sir, what is the outlook for FY23 for carbon black sales, sir?
So I think we are reviewing it, and we'll come back to you in the next quarter about the revenue, the outlook for next year. For the full year, we'll give you the outlook in the next quarter.
Thank you so much, sir.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah. Hi, sir. Good morning. Thanks for taking my question, sir. So my first question is on the tonnage per se, volume growth. So you indicated Q4 tonnage to be similar at 70,000 tons. Usually our Q4 has been typically quite strong per se, but you seem to indicate similar volumes for Q4 and the Q1 and Q2 of the next fiscal also. So are there any headwinds in specific geographies or segments that you're seeing that keeps us slightly cautious when it comes to the near-term outlook per se?
So basically, you are absolutely right that our Q4 has always usually been the strongest. But here our bottleneck would be capacities. We are already running at about 100% capacity, close to 100% of our capacity, and this would be our run rate for the next 3 quarters till the till the new announced projects start kicking in.
Okay. So the new capacity will come in Q3 beginning of next fiscal year.
Yes.
Okay, understood. So the other thing is Europe as a geography has done exceedingly well. If you look at Q2 and Q3, I'm leaving Q1 aside because the base is very different there. Just in Q2 and Q3, the volume growth as well as absolute volumes has been quite strong there. Is this all largely agri-led in Europe, or what is happening? If you can give some flavor.
So agri is also strong, which was our strong forte, but also we are seeing a good offtake in the industrial construction in OTR, for which we were going through a lot of trials, and now that the product has been accepted for that as well. So the response has been good in both sectors.
Okay, understood, sir. Understood. Got it. Sir, the other point is from a cost perspective, you indicated around 130 crores per quarter kind of marketing ad and promotion spend. So that would imply something close to 520 crores for this fiscal year, compared to close to 340 crores for F21. I understand we have to do these spends to improve our brand presence.
Sorry to interrupt you, Oya. The number that I told, 120 to 130, is for the whole fiscal year, not for one quarter.
Okay. What is the comparable number for last year as per?
It was similar, but if you recall, last quarter I said that we are going to increase marginally. So I think it was about 100, 110, which is now going to 120, 130. That is for the whole year, not for per quarter.
Understood, sir. So, sir, my question is, we are in a commodity inflation scenario. Logistics costs are going up. We also have to keep up our marketing spends per se to remain competitive. Therefore, in this scenario, and not lose market share or anything of that sort. Would it be more prudent to cut our margin band so that we can remain more competitive in the marketplace while maintaining our investments on the brand as well as the other inflationary headwinds we are facing on different fronts?
No, we don't look at short term. I mean, we always look at it long term. So our guidance has always been that we will have we would like to sustain it in the long term. If you recollect my comments and all from last quarters, also last year quarters when we were at 32, 33 also, we had clearly indicated that these numbers are, we expect a BKT, BIL to sustain between 28 and 30%, and which we are continuing. Quarterly hiccups can come both upward as well as downward. But if you look at it, our, as a management, our endeavor is to continue to be in the bracket of 28 to 30% long-term sustainable EBITDA margins. And that's what we are working towards.
Sure, sir. Sure. So that is very helpful. Sorry, before I conclude, one last point, sir. So given the capacity challenges we are facing, and from Q3 onwards, a new capacity is coming through. So, but that capacity will also take some time to ramp up. So just directionally, will a double-digit volume growth for next year be more challenging, given the capacity challenges we are facing at this point? Just direction, sir. I'm not putting you in a spot for a specific number.
For next year, our guidance we will give you at the end of Q4 in our next quarterly result. It's too early to give any guidance. Let us complete this year. Let us complete our guidance, what we've given for this quarter and this year. Let that get completed, and then we'll come back to you at the right time for next year's guidance. It's too early to comment on that. We've not even started the year. So give us time and we'll come back to you on that.
Sure, sir. Thank you very much. Best wishes.
Thank you. The next question is from the line of Devanshu Sampat from Yes Securities. Please go ahead.
Yeah, hello, sir. Good morning. Two questions from my side. So if I look at the past 2 years, it seems that the contribution from the OEM segment has been increasing. So how are you balancing commitments to OEMs as well as maintaining the replacement demand at a time when you have capacity constraints? And is this possibly the reason for margin pressure? Apart from the input cost aspects that are there, this is with the assumption that you get better pricing in the replacement market. If you can comment a little bit on this for both agri and OTR.
Yeah, so I commented on as a company as a whole. As I mentioned in my opening remarks, the EBITDA margins were affected on higher power and fuel costs during the quarter because of some shutdowns when we had to run our coal boilers. So, when that, unfortunately at that time the coal prices had started to go up, so that impact had come in, and there was some increase in raw material cost and logistic cost. Along with that, there was a bunching of some marketing spends which came in Q3, which was actually supposed to be for the whole year. So that is what has led to this. So we don't see it as a increase of OEM or a replacement market or any of that to have an impact on our raw material or our EBITDA margin. So that has nothing to do with it. And we don't expect that to also drag down our EBITDA margin. So that is not what has impacted that.
So would it be safe to assume that margins are pretty much similar for both segments?
Yes.
Okay, and what's the breakup between OEM replacement in OTR, if you don't mind sharing that?
So we don't have that segment-wise breakup on OTR and this. We can give you as a company as a whole, we were 70% from replacement and 27% from OEM, and balance 3 was offtake.
Okay, and the last question, once you're post all your capacity expansion, including the carbon black 200,000 tons, what will be your, how much will be the requirements on a 360 ton tire capacity?
Roughly about 25 to 27% of our finished product. So if you're talking about 360, so roughly between 90 to 100,000 tons.
90 to 100,000
self-consumption.
Got it. Okay, sir. Thank you, and wishing you all the very best.
Thank you.
Thank you. The next question is from the line of Sunil Shah from Total Star Portfolio Managers. Please go ahead.
Yeah, so thanks for the opportunity. It's not more of a question, it's more of a thought. So the way in which we backward integrated into carbon black has really favored us in such a situation when the crude prices are going up. So that's really commendable. So on similar lines, as a company, we would spend a lot of money on automation modernization. So our power cost is one major factor. So anything that we intend to do for putting up some kind of a solar plant or reduce our dependency or increase our captive power generation. So anything on that will add up to sustainable margins or increase our margins as well. So is anything back of the mind, could you please share?
Yeah, so Thank you for your thought, and it sort of validates what we have been doing at BKT, because if you see our program for expansion, we have expanded to set up a new captive power plant already at Bhuj, which is ongoing in the capex spend that we are talking about. So that is already there. We have even if you see my opening remarks where we said about solar power investments. So we have done some of that, and we are reviewing the situation, and we will take it forward as and when other projects are down. So that is that the coal power prices went up because in the last quarter there was some marginal, for a few days there was a shutdown in our cogen power plant, by which we had to run our older boilers which run on coal, and that had impacted the power cost.
Fine. So just one sense, how much of our power requirement is currently met from our capital sources as of now, and then when we go to the additional capacities, how would that be?
So at Bhuj, we are practically currently at about 80%. Once with the new production expansion and new power plant coming up, we should be close to about 95%. And in the other plants, it is about roughly about 40% through solar power, through windmills, etc., which are being generated.
Fine, sir. Thank you very much for all this. Thanks.
Thank you. The next question is from the line of Ankit from Smart Sync Services. Please go ahead.
Thank you. Can you just highlight what is the price differential we have right now with our European and American counterparts, specifically the likes of Michelin and others?
Sorry, your voice was not audible. It was very muffled. Can you repeat that?
I was asking about the price differential, as in what discount we sell our products currently compared to our European and American counterparts at the current juncture.
So roughly 12 to 15%.
12 to 15%. Okay. And do we maintain that going forward also, or do we see that bridging?
Yes, in the short term, we look to maintain that.
Okay. And sir, how do we see, as in the situation where, as we are already near 100% capacity, and our capex plan is more towards is going to come up by the end of FY23. So, can there be a situation in the first half of next year where we may not be able to cater to the demand, as we have already guided for a very good demand environment?
Because that's what we said is that the next 3 quarters will be we are at full run rate, and then once the new production capacity comes on board, you will see the jump coming in.
Okay. Thank you.
Thank you. The next question is from the line of Naresh Sudhar from SBI Life Insurance. Please go ahead.
Yeah, my question has been answered. Thank you.
Thank you.
Thank you. The next question is from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes, good morning, Rajiv, and to the team. Rajiv, my question was on the OE customers. So what is the nature of contracts do we have with them? I'm assuming it could be a little different than what we have with our distributors.
Yeah, so I think it's it's a little bit more formal in the sense there's agreements and also where we have to give commitments of capacities and all, which we are giving, and we are adhering to that. There is also a long-term understanding between both parties, as to they will continue to make sure that they are buying. So then, it's a little bit more formal kind of an agreement, which both parties then need to adhere to.
Okay, and the pricing is it index-based or would it be spot?
It's very difficult to give a generic answer. Some cases is index-based, some cases is on the spot, and similar to how we are selling in replacement. So it's a mix of both.
Okay. Any rough guidance on the proportion between spot and...
No rough guidance, but yeah, by and large, the overall replacement and OE margins are at similar levels.
Okay. That's it, Rajiv, from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sanjay from Ampersand Capital. Please go ahead.
Yes, sir. Sorry if I am repeating the question. If you can just help us understand about the margin which you have given, that it will be bouncing back to 28-30% in the long term. So what really will make you to go back to that kind of margin level? Will it be simply decline in cost structure, cost pressure, or there will be something more?
So I repeat my statement once again. So what we have always maintained, sir, is that the EBITDA margins, that our endeavor is to continue to maintain an EBITDA margin of 28 to 30%. If during last year and my earlier commentary also you heard when we were at 32, 33%, we had said that these are not regular. Our sustainable long term would be 28 to 30%. Even now when it is down to about 24, we are maintaining the same, that our endeavor is to go to 28 to 30%. We are looking at, how do we get there? Would be by price increases. We are going to review the cost structures. If the shipping cost, raw material prices continue to be strong, we will be forced to pass on that to that aspect to our end users, our distributors, who will then pass it on.
And last thing, if I can just understand from you, is that your end customer base is inherently cyclical in terms of demand, and of course you have a far lower market share, but you are adding capacity. So considering the inherent cyclicality of your end user segment, how confident are you about the demand, let's say, beyond next 5-6 months?
So even with the new capacity coming on board, our market share will go to between 7 to 8%. So it's not going to be where we will be a very big chunk, 30%, 20%, 25%. And also the capacity will be added in a phased manner. So, by the time the demand, by the time the capacity comes, it's not going to come on day one. It will take us few months to ramp up and reach that level.
So does this mean that irrespective of the end market cyclicality, you will be able to sustain about something like 10-12% kind of volume growth each year?
Yes, that is our endeavor.
Thanks a lot.
Thank you. The next question is from Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good morning and thanks for taking my question. So just could you quantify the impact of the higher power cost this quarter and higher freight cost? I mean, where is freight cost now as a percentage of sales?
No, that I don't have those details readily available with me. We can't quantify it.
Okay, and but I mean, what we are hearing is that freight costs have started coming down, and the other thing was, I think you were passing on some of the freight costs as a surcharge, right? So to that extent, incrementally, that versus Q2, it would not have been a negative, right?
No, there's some cost has gone up beyond. So we started passing on in the beginning of Q3. The cost went up beyond what we were passing on. So we are reviewing it. But as you rightly said, the prices have started softening, and hence we are not reviewing a price increase in this quarter, as what I mentioned to you earlier, because it's difficult to pass on and then go back and on. So we are reviewing the situation. This is for the freight I'm talking about.
Got it. No, so the freight surcharge you were saying is that there's no incremental increase in that because the prices are now, the freight costs are now coming down.
Yes.
But this quarter it has been higher than what you actually passed on to the customers.
Yes.
Just another thing was on, I mean, could you give us a sense of what sort of market share would you have in European agri tires?
It would be difficult to give that breakup, but roughly about 10 to 12% overall in the agricultural European market.
10 to 12% in agri European market.
Yes.
Okay, sir. Great. Thank you so much.
Thank you. The next question is from the line of Desha Seth from Annual Wealth Management. Please go ahead.
So I just wanted to ask that when you said the natural rubber is 160 per kg, and you mentioned that the margin for Q4 will remain at the similar level as Q3.
So I was checking, in spite of the increase in the raw material basket, how will we manage to keep the margins at the same level? Is the operating leverage kicking in because of full capacity?
Yes, yes.
Okay, that is the reason. Okay, and sir, on the long-term basis, what is our volume? We look at as a volume growth guidance over next 4 to 5 years. We plan to increase by 10 to 12%.
Yes, that is our endeavor.
Okay. Yeah, that's it from my side. Thank you.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
So hi sir, we had mentioned last quarter that the realized rate was 87.75 and we're looking at forward rate of 89.7. But this quarter also the rate is only 87.3. So when do you expect to realize this 89.6 rate? Will it come through in fourth quarter or it will be next year only?
So because we don't do 100% coverage, there's about 50-60% of the forward is hedged. So there will be some delay, but time lag, but we should see it in the next few quarters to come through.
So even now the mix is almost 50% is spot and 50% forward.
Yes, by and large.
So then because current spot rate is around 85.5, so then the rate should not increase much in the coming quarters, right?
It should be. So, this is the average rate, so we should see it coming in towards the end of this quarter, and then true reflection would be in the next quarter.
Okay. And secondly, while we are passing on that freight cost element to the customers, is it that in case of OEMs, because they also source locally in their contract, we are not able to fully pass on this freight cost impact versus replacement market? Or we are able to pass it to OEMs as well because they would be buying from local suppliers as well, and for them the cost is not increasing so much.
So most of our OEM contracts are, it's a mix of it, but some of them also on FOB basis, so that aspect gets clear. So we are working closely with them to see how much for the other half whom we are doing with logistic cost. We are working with them to see how it can be managed.
And lastly, you said that this quarter marketing cost was higher. So generally we targeted of 120-130 crores for a full year. What was the number for this quarter per se?
So roughly, if you earlier it would be about between 100 to 110 crores, which has gone up to 120 to 130. So that differential amount has come in this quarter, which will roughly that has come in this quarter, and that will be bundled out.
So that entire 10 crore extra has come in this quarter, you mean to say?
Yeah, about that much, yes.
Oh, that will be all from me, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Nikshita from Credent Asset Management. Please go ahead.
Hello. Thank you for taking my question again. So, as I just wanted to understand how much power cost and how much carbon black cost does, what percentage of your cost does it form, and how much do you see it reducing by this the capacity addition and this new capex? Hello?
We will come back to you on the breakups offline.
Okay. All right. Thank you.
Thank you. The next question is from the line of Devanshu Sampat from Yes Securities. Please go ahead.
Yes, sir. Thanks for the follow-up. Just a few questions about your carbon black views on the market and stuff. So can you talk about the outlook on the prices and volumes? And there's also news of India's largest carbon black player expanding capacities by about 150,000 tons by the end of the year. So how do you see this playing out?
So on the carbon black, our current levels are about 95 rupees, approximately. And for the current prices are at roughly about 100 rupees per kilo. And anyway, for us, our main business will always be tire and not carbon black. So that is not that. This is mainly for our self-consumption. And third party will be, with third party coming in also, it will be roughly 3 to 4% of our overall sales volume. So it's not new business as such that we are looking at. It is just to complement our own tire consumption.
Okay, how exactly are you selling this to third parties?
Sorry?
How is the distribution for when it comes to third parties? Are you doing it locally or is it exported?
It's a mix of both. There is a small amount which is exported, but mainly it is local.
Mainly local, okay. And this 30,000 advanced carbon black, is it all used in tires or it has other applications?
No, it's not advanced carbon black. It would be specialized carbon black. It would be in other industries.
Okay. Thank you.
Thank you.
Thank you. I now hand the conference over to the management for closing comments.
So we thank everybody for taking the time out to be a part of our call, and we hope and we wish everyone along with their near and dear ones continue to remain safe in these challenging times. Thank you.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.